FirstWave Cloud Technology is out with its 4C today. It is touting its control on costs while concurrently investing in sales and marketing. It's in the business of cybersecurity and network management. So let's find out what's going to happen from here with its CEO, Maher. Hi, welcome. Thanks so much for joining us. I know these days are really conversation heavy. So what are the conversations with the shareholders that you've been having today been like?
Well, we had a general update for our shareholders as we do at the end of each quarter. It was all pretty positive messaging. You know, we had another great quarter. At FirstWave, we made an acquisition 12 months ago of a company named Opmantec. So the message today to shareholders that, you know, you really need to, and to other investors, is that if you've looked at this stock previously, you need to have a look at it now again, because it's a completely transformed company. Quarter on quarter, the last quarter, our gross profit grew 30%. Our revenue grew just under 11%. We've got a massive pipeline of opportunities, particularly in North America. And it's a very different company to what it was 12 months ago, and we're all very excited.
What's your edge, though, in North America? Because I would presume there's a lot of suppliers like yourself there.
Yeah, you're exactly right. Particularly in the network management field, which is our main driver into North America, there is quite a number of suppliers. Our key is, you know, we boast companies such as Microsoft, NASA as clients, large telecommunications providers, but our intellectual property is much more scalable. So the more complex the environment and the larger the environment, the less competitors we have. So yeah, we've got some really key blue chip clients and some great technology which operates at high scale.
So everybody wants to know when small tech companies will become profitable. But, you know, before that, you've got a slow cash burn. You've got to make sure you've got sales coming through and the pipeline increasing. You know, ARR. How do you slow that cash burn? Are you still in the process of doing so, even as you try to grow in North America?
We are, but we do want to invest in our growth. So we're investing in sales and marketing in particular, and in particular in North America, Australia, and Latin America, and in particular looking for large enterprises and service providers as clients. In terms of our cash burn, in the first half of last financial year, we were burning over $1 million a month. We're now burning under $500,000 a month, and that's through really some stringent restructuring, re-strategizing, and cost controls. If you look at when Opmantec was acquired by FirstWave, so that was in January of last year. So we've acquired a company, doubled the GP with that acquisition, okay? And incredibly now, if you look at the total cost of the business now, the total operating expenditure now is lower than what it was prior to the acquisition. So we've acquired another company, embedded it into this company, merged it in, and yet incredibly the operational expenses are lower.
Now, can you improve margins further?
We can improve margins further. Part of the acquisition was we picked up a bunch of IP, which is it's all software, so it's basically 100% margin. Yeah, sometimes there's some support services that go with it, but all the cash stays in our company. And as we drive that software into these large enterprise accounts, particularly in North America, we are going to see an improvement in margins. And with an improvement in revenues and improvement in margins, we're also going to see that cash burn come down. We're very excited about the upcoming couple of quarters. You know, we've got line of sight to some key deals, and it's quite a diversified pipeline, so we're not reliant on one deal or two deals. There's multiple customers on multiple products in multiple geographies. And there's a couple of really big ones which we're hoping to pull in soon.
Okay, and just finally, you know that the market is really, really hungry for any sort of timelines that companies can put on cash flow, break even, profitability. Is it too premature for you to be putting a hard timeline on that?
Well, we put a timeline on being cash flow break even by the end of next financial year, but we're doing pretty well. Everything's on track for us, and we've got an extremely strong pipeline. So I'd love to see that happen earlier, but we've got enough cash in the bank to continue to execute our plans, and we've got enough levers to pull that if anything doesn't go to plan, then we can adjust the plan. So we want to continue to invest in sales and marketing. It wouldn't make sense for us to be cash flow positive right now with the opportunities we have on the table. We have to go and close those deals, grow our business, and we're in growth mode. But nonetheless, we're on plan to be cash flow positive by the end of next financial year.
Okay, and look, are you tempted to make any more acquisitions, or do you have enough on your plate right now?
We're busy with what we've got on our plate, that's for sure. You never say never. There's a couple of areas of opportunity within our current client base where we could develop new technology or acquire new technology. But basically at the moment, our three strategic pillars are, be a sales-led organisation. So right throughout the company, adopt a sales culture, grow our revenues faster, and keep our costs under control. So that's the three things. We're not acquisitive at the moment.